Today is Wednesday, June 28th, and welcome to this week's In the Know Trader Show. What are we going to discuss? Well, the topic of the week is to learn the value of using pair trades. We'll get into that in a moment. Beforehand, let's talk about what In the Know Trader products there are. I just started last week, many of you know, and so many of you have already subscribed to the daily tip sheet. This is a brand new product that gives you all the key information you need to know on a daily basis about the markets, what the key levels are, where you need to be focused for the upcoming day. I also include a few times a week new trade suggestions. They can be in stocks, ETFs. They can be done in the options market. On occasion, I might even use a futures market. I'll pick the best place to express the idea that I want you to do. That's a daily tip sheet. You can sign up now on inthenowtrader.com. I also have my weekly tactical trader report. That report comes out Thursdays and reviews the entire macro background on every significant market that has a major impact on the U.S. equity market. So we're talking about reviewing the U.S. 10-year bond market, credit spreads, the U.S. dollar, gold, crude oil. Those are always written about each week. I then give you a brand new ETF trading idea each week, as well as review all open positions we have trade by trade until we close it out. That's the weekly tactical trader report. Comes out once a week. And I also have my 7-11 monthly spider sector ETF report. This is the report with the goal of beating the return of the S&P 500 over time. This is for longer term investing. And what I do is I choose no more than 7 of the 11 spider macro ETFs to be invested in at the beginning of each month. Now, I don't make sector changes that often, but I do tweak the actual allocation to the sectors that I'm choosing. And to give you a sense of how well this has done in the 34-month history, let's look at the stats right beneath here. Last year, the 7-11 report outperformed the S&P by just over 6%. And I beat the S&P in 11 of 12 months last year. In the most recent month, May, and we're going to have another month finish in just a couple days, but through the end of May, we outperformed by 28 basis points in May. That puts us up 43 basis points on the year. And in the total trading history, going back to August 1st of 2020, this 7-11 report has outperformed the SPY, the S&P 500 tracking ETF, by 13.58%. That in money management arena is a huge, extraordinary return above and beyond the S&P when our only input variables are the 11 sectors of the S&P itself. And we're always going to choose 7, so we keep 4 out with the goal of staying away from the underperforming sectors. If you stay away from underperforming sectors, you will outperform over time. The performance of roughly 13.6% above and beyond what you would have gotten if you were in the spider in the same time puts me in the top 10% of all money managers out there who are benchmarked to an index, who are playing the game of trying to beat the S&P 500. So I urge you to consider subscribing to this report. All reports I have get 7-day free trials. And I urge you to strongly consider this if you have money in your account, in your long-term investing account, sitting in spiders, and you have just general broad market exposure through a passive index like that. I urge you to consider this to put a significant amount of money towards, because you'd be, for example, if you had a $100,000 account, you'd have an extra $13,580 in your account as of now, compared to if you were in spiders over the same 34 months. If If that excess return doesn't tickle your fancy, I'm not sure what will. So all these products are available, including my coaching services, and that business keeps picking up. More and more people come to me to help coach them to become better traders. So you can sign up for a single hour. You can sign up for a package of 3 1-hour sessions at a deeply discounted price. I have people who buy multiple 3 session packages all at the same time up front because they really want to learn how to trade better, and they're willing to put the time and effort in to learn from somebody who's been doing this successfully for over 40 years. Subscribe to my In the Know Trader YouTube channel. Go to YouTube, go youtube.com/In the Know Trader, click on the subscribe button, and then every time I do one of these videos, it'll appear on your homepage as soon as you log into YouTube. Follow me on Twitter. My handle there is @In the Know Trader. So let's get to this week's topic, pair trades. What are pair trades? Well, a pair trade is being long one security versus short another like security. Examples that off the top of my head include something like being long Lowe's and being short Home Depot against it. 2 home improvement stores, chains, very, very similar businesses. They're going to tend to move together up and down, but ultimately one is going to outperform the other. So in this example, I'm saying if you bought Lowe's and shorted Home Depot against it, that's a pair trade. Another example, long Coca-Cola, short Pepsi. They are going to move similarly. They're not exactly the same company, but they're in the similar beverage/snack space, and they're going to move similarly. But one of the two is going to be better over time. Your goal is to be long the one that you think will be better and short the one that will underperform. Here's another example, long QQQ, the NASDAQ 100 versus short spiders, the S&P 500. That's a pair trade. Similar, not exactly the same. Obviously, Qs are technology. The S&P is broad-based index, but still of large cap, mega cap names. And that is an example of a pair trade. Let's say, take something in the commodity space, long gold versus short silver. That's a natural pair trade. Precious metals generally move similarly, but one of those two is going to do better. Your goal would be to do your research to figure out which one is going to do better, and then you put on the pair trade. Now, you could just buy gold outright, but if gold comes off in price, you're going to lose money. If you buy, and this is, again, I'm just talking theoretically, if let's say you put your pair trade on of long gold, short silver, but instead precious metals come off. Well, as long as silver sells off more than gold declines, you will make money on this trade. So even if you got the direction of the market incorrect, or in this case, let's say the direction of gold incorrect, you can still make money because you're short silver against it. And as long as, let's say, gold sold off 4%, but silver sold off 6%, you're making money, even though having bought gold is the wrong thing, but it ended up being right because you were short silver against being long gold. These are examples of pair trades, and they can be very effective tools in your overall trading regime of different ways to approach the market. What else do we have? Generally, a pair trade eliminates overall market risk to simply focus on the relative performance of 2 like names. Let's go back to, let's say, Lowe's versus long Lowe's versus short Home Depot, if that was the pair trade. And of course, you could put this on the other way. You could be long Home Depot and short Lowe's, whichever one you think is going to do better after doing your research. Which company to you is the stronger company that's going to have better results over time? That's the one you want to go long, and then you find that a natural pair against it. What's the advantage of this is that it eliminates overall market risk. Let's say you're bullish Lowe's, you buy the stock, but now the whole market goes down. you're likely going to lose money in Lowe's, not because you were wrong about Lowe's, the company, but because the whole market moving lower dragged most stocks down with it. But if you had bought Lowe's and shorted Home Depot against it, the decline in the overall market is going to drag both stocks lower. And because you're short Home Depot, you're actually making money on your short to offset most of the money that you're losing, if not all of the money you're losing in Lowe's. So you take the market risk away, because if the market goes against the way you want it to, you've got another name on the opposite side of the market that's actually making you money. So what pair trades allows you to do is to say, I can't quite figure out if the market's going up or down over the next 6 months, but because of my research, I think stock A is a better name over the next 6 months than stock B. I can buy A, short B, and make money regardless which way the market moves, because I've got one long on versus a short. Now you're just playing the relative performance between those two individual names, and you essentially take away the market risk. You do need to have a margin account if you're going to trade a pair trade, because you're going to be short one of the two sides, right? Long one and short the other. Make sure you're set up for a margin account, because otherwise you're not going to be able to short a stock. Next, you buy and sell equal dollar amounts, not share amounts. You don't buy 100 shares. In the example I gave before, you do not buy 100 shares of Lowe's and sell 100 shares of Home Depot against it. Unless their share price is trading exactly the same when you put this on, that's not going to work. What you do is, let's say you decide to do, I will buy $5,000 worth of Lowe's and I will short $5,000 worth of Home Depot against it. So it means pulling out a calculator and just seeing where the share prices are for each. Take 5,000 divided by the share price, and you'll know how many shares to buy and sell of each. It's a great way to play the bigger macro trends, but with a hedge, so that if something happens, and let's say an exogenous event happens, remember when COVID hit back in 2020, remember earlier this year when the banking crisis hit, things happen that can drop stocks, the whole market, very quickly. If you have a pair trade on, because one of the two sides is short, if the market were to just fall, that short is going to offset the bulk, if not all of, or beyond all of, what you're long. So you have a hedged trade on, and it takes that fear away from, oh, am I buying at the wrong time? Look, the market itself has been up straight since the October low, with a few pullbacks, but obviously we're near the upper end of the range. The S&P had bottomed near 3,500, and now it's, let's say, 4,350 or so. So we've had a significant 850 point move up in the S&P. Certainly, you could be worried that at any time it's going to pull back. If you first buy a stock now, you've got that immediate risk of having bought high in what so far has been an uptrend. But as we know, uptrends certainly pull back. If you put a pair trade on now, you do your homework, you decide what name you want to be long, but you find a name in that same category that is not nearly as good a company, and you short that one against it. Now you have protection, because if the market were to just fall, your short will make some money to help offset what you just bought. So you take away that market risk, and now all your trade need to do to work properly is to have the one that you're long have better overall performance, even if it's negative, than the stock that sells down. And here, let me show you, as I finish up this week's topic of the week and lesson of the week, here's an example of a pair trade that I recommended about 4 months ago to weekly Tactical Trader Report clients. So this went out on a Thursday evening, roughly 4 months ago. And the pair trade was to go long XLC, That's the communication services ETF, one of the big 11 that make up the 11 sectors of the S&P, versus shorting the XLE, the energy space. So go back about 4 months, and I had suggested and seen reasons to believe that communication services was going to do better than the energy space. Now, up until that point, we go back a few years, going back to 2020, this chart has been heading lower. So if it's long XLC, short XLE, being long and short in this combination was not good. You would have made money if you were long XLE and short XLC. So this has been trending down, but I noticed 2 sequential 13 bottoms made in the last year, along with some 9 counts. I started drawing an uptrend line. I noticed that the downtrend line had broken. So back here in February, we got long this pair trade. We bought XLC and we sold an equal amount of dollars worth of the XLE ETF. So I had a long and a short on. We paid about 0.67. That's the ratio, just happens to be the ratio of what the price is of XLC divided by the price of XLE. 0.67 would imply that XLE is trading at a higher price because we're paying less than a ratio of 1 to 1. So we paid about 0.67. And a couple of weeks ago, I recommended taking half off around 0.82. So if you buy something at 0.67 and you sell at 0.82, you've made 0.15 divided by 0.67, the initial starting price. And that's a 22% return that we've made, not caring which way the overall market went. We simply made money by properly playing 2 of the major 11 sectors of the market against each other to anticipate which one was going to do better than the other. And clearly, XLC Communication Services has done well better than energy, which we know happens to be this year's worst performing sector after it was last year's best performing sector. So this has been a home run trade. We took half off to lock in very solid profits, and I still have half on. I've adjusted the stop out level on the remaining part to protect the profits. I don't want to see it disappear. If this 9 count that we saw a week ago ends up being the high of the move and it all of a sudden fades back down, I don't want to give it all back. So subscribers know where that stop loss is, where we'll just exit the other 50% and have just a terrific trade. And I frequently put it on pair trades in the Tactical Trader Report because it's a great way to be able to make money and not have to figure out your perfect timing of when you're buying in the market's rally or shorting potentially in the market's rally. You've got one on each side. So if the market goes up, you're long something, the short will lose, and hopefully the long makes more than the short loses. And if the market goes downward, the short will help protect the loss on what you're long. But if you did your research properly and the long is the better company or the better, in this case, ETF to be long versus the short, you're still going to make money. And that's the beauty of pair trades. So that's this week's lesson. I hope it's valuable for you and that you learned something. And really, check out the products that we have at In the Know Trader. I now have a daily product for those who like to trade frequently. I have a weekly product, which is going to put out approximately 50 trades a year. Good for people who like to hold stuff for kind of short to medium term. And then I have the monthly 7-Eleven report, which is for longer term investing and is cleaning up versus just if you had spiders in your account. So lots of good stuff here at In the Know Trader. I'm Rick Benson. Have a good week.